I'm gonna get straight to it. Straight to it. First thing I'm gonna say, this video is risk management 101. If you do not understand risk management, if you do not have risk management at least like down and a little bit understood before you start, trading will be kind of complicated. I'm not even gonna lie to you, because like this is the actual, like, a lot of people kind of like a lot of people go past risk management. No, risk management. That's why this is the second video, because this needs to be one of the first things you got to understand when you come in. A lot of people, well, really everybody, want to come in to trading and to forex to make money. So this is how the money is actually being made. This is why I made this the second video besides the actual market structure video. So forex is traded. I'm sure a lot of y'all know about stocks, where you buy a share, or you buy a certain amount of shares. Forex is traded in units. So we're trading units of a currency. So 100,000 units would be a standard lot. 10,000 units, 0.10 lots, 1,000 units, 0.01 lots. If you're a beginner, definitely look at the 0.01s, 0.01s, 02s, 3, 4, 5, all the way till you get to 10, then 0.10, 0.10, 12, so on and so forth. Though that lot is your multiplier. That is where your magic and your money is. Let's go right here to 100 pips. You see, if you have 100 pips and you got a 1, that 1 is 1 lots over here. So that'll be $1,000 if you get 100 pips. I'm gonna go over what a pip is in the next one too. And if you get 100 pips on a 0.1, then that's $100. If you get 100 pips on 0.01, that's $10. Now, what is a pip? That's what this little box is over here in the top right corner. A pip, a normal pip that you would see like on a lot of normal forex pairs, the pip would be the second to last digit. So in this case, it would be this 4 right here for most normal pairs. When I say normal pairs, you can look over on the side and you'll see like AUD, USD. Most of these digits with about 4 decimal places, 4 to 5 decimal places. Those are like normal forex pairs, and the pip would be the second to last digit. So that would be this 4, or this 1, or this 8, or this 8, so on and so forth. For JPY pairs, like USD JPY, GBP JPY, right now on this chart is Euro JPY. It's the same scenario. It's the second to last digit, except that for JPY pairs, you only got like 2 or 3 digits. So that's the difference. Nothing really too major though. So now these boxes down here, these are your risk to reward ratio boxes. Over here to this one, you see on the left, this one say 10 for 20. So in this scenario, you'd be risking like 10 points for 20 points. And if you do that at a 0.01, then you'll be risking $1 for $2. If you do that at a 0.1, you're risking $10 for $20. And a standard lot, you'll be risking $100 for $200. You can see they go by ratios pretty much. So let me draw out the brush real quick. I was trying to make this video short. I already know it's gonna be long. Let's say you're in the trade, right? The trade doing this thing. It enters like right here at this little gray line. So if it heads down to the stop loss area, then you would, depending on your lot size, if you're a beginner and you have a very, very small lot size, being a 0.01, then technically you would have lost $1. I'm gonna keep it simple. I'm gonna just say like 0.01. Now let's say it's the other way around. Let's say you're in a trade and it actually goes up. You win $2. So that's how actual risk to reward pretty much works. Like your risk to reward, you should get back more than you lose. At least not every single time, but like generally most of the time, if you keep following this rule. This next box over here, this is 3-to-1 risk to reward. So you be risking 10 pips for 30 pips. So for a beginner, that'll be $1 for $3. The more advanced you get, that turns to $10 for 30. And then you have to work your way up, like, or you don't really have to work your way up. If you just want to start off, if you got enough capital to put into a trading account and you feel like risking $10 for 30 or $100 for 300, then I mean, go for it. With this last one, same scenario. This 2-to-1, this 3-to-1. So this is the 4-to-1 risk to reward. Pretty much like my favorite one, because you see you're risking 10 points for 40 points. Points and pips, same thing. So for a beginner, you're risking $1 for a certain trade to get $4 back, which is good because, like, let's say you take a trade and you take a trade like 4 times. The first one lose, the second one lose, and the last 2 hit. So you lost $2 on the first 2 trades, but you made $8 on the last 2 trades. So at the end of the day, you still made some type of money. $2 on the 0.01 is $20 on the 0.01. It's $20 on the 0.1. It's $200 on a standard lot or one. So you can kind of see, like, with trading, you should not continuously lose. Like, if you continuously losing in trading, you just don't know how to trade. And you just have to keep getting better and better. But for the most part, like, these ratios, it's like probability. Like, what are the chances that you'll hit? 9 out of 10, like, if you really, like, with the trading game, like, you will continuously hit. Or if you don't hit, your loss shouldn't be such a big loss that it makes you feel bad or anything like that. Like $1, like, if you knew, like, come on now, $1, like, that shouldn't be nothing. But it's just the idea of the ratios of how they go. So let me just drop an idea of, like, how my trades would go, or like how the trades would go that I send out sometimes. I think recently the trade that I sent out, it was Euro USD. So I said it was a 22 pip stop loss. So that means this area down here, I'm gonna move this up the way. This box was about like 22 pips. It wasn't this exact pair, it was Euro USD, but I can give the idea of how I had the trade set up. And my take profit was 60 pips. So you can see that it was about, like, almost a 3-to-1 risk reward. It was about a 2.71. But that was just TP1, because I actually had my trade going for about like 160 pips. Yes, 160 pips right here. About a 7.27 risk reward. You don't always have to stay at 3s and 4s. Like, you can over leverage it, or you can send your take profit like however far you want. But just like, you just have to have the idea of the ratio. So in this scenario, if you lose, it's 22 pips. So if you lose, then that would be $2.2 for a brand new person. And if you do it at a 0.1, then that's $22 that you're risking. And then for standard big boy lots, that's $220 that you're risking. But that's just how much you're risking. Let me keep it simple. Real simple. 0.01, $2.2. So that's how much you're risking for this trade. Like, when I say risk, I'm saying, like, if it hits stop loss, that's how much you should lose. But my first take profit, it was like 60 pips. So you're risking $2.2 to make 6 back. 2.2 for 6. Like, at the end of the day, like, even if this trade actually hit stop loss, I'm not gonna lie. I apologize for the stop loss. It's all good. Definitely gonna bring it back soon. You're risking $2.2 for 6. So that was just TP1. TP2 I had was $100. I mean, 100 pips for $10. So if you did let it go to TP2, or if you would have let it go for TP2, you would have risked $2.2 for 10. And the last one being 160. $2.2. If you would have took the trade and you just held it all the way until it was completed, that's $16 as a new person. Like, 160 pips as a new person, like, that is, like, that is pretty cold. So let me go to an actual example of where I can show. I know I got it set up somewhere. Not this chart. It's crazy. I thought I was organized for this call. I guess I'm not. Oh, let me go back. UJ. UJ is good. I actually have a limit set like down here. I don't have the limit set, but I understand once it comes into this area, I definitely want to take a trade. So now we zoom out and we look at the trade of how we want it to go. You see it's going sideways and went sideways a little bit, spike down, it's making its way up. I want it to come back down here and then continue to make its way up. So this trade is a 29 pip stop loss. Remember, this is the this USD JPY. JPY pairs, they have a different pip count from the actual other regular pairs. So the stop loss is about 29 pips. You can round it off to 30. So it's about 30 pip stop loss. And to take profit, you see it's about 200. So you're risking 30 points to catch 200. So in this scenario, keep it simple again, 0.01. You're risking 30. You're risking 30 pips, so you're risking $3. I'm sorry, hold on. We go to USD JPY. Overall, a lot of same. All right, so 2.79. That's how much you're risking. Now, if we do, I'm not necessarily like, you don't have to always take it up to the take profit. Like sometimes if you feel comfortable, like let's say you're in the trade and price goes up, it goes up 30 pips for you, and you see $2.79 as a new person. If you feel comfortable with what you see, close out the trade. Like secure the bag, still secured, or you can have multiple positions. That's actually a risk management strategy that I'm gonna start using. If you have multiple positions, you can have 1.01 going to like 30 points, and then you close it out, and then you can have the other position going all the way to 200. If it do go to 200, that's 18.65. Calculator. So the first position, and I'm gonna go over positions before I end this call too. The first position you closed out with 30 points. 30 points. Look at this big ass calculator. 30 points. So 2.79 plus 200 points is 18.65. So in total, that's like 21. That's $21 because it's $21 in total because you let one position go all the way to 200 points, and you close out another position when it was up about $2.79. That's gonna take a little minute to understand. I really need to do a whole call about that because that's actually gonna be a little harder. But just so I can wrap this call up, so I can end it. People, I also got a sell limit up here too. I'm doing the fool right now. When we talk about positions, this is one trade that I actually want to get into. This is the trade that I'm going to get into. So assume this is one position that I'm gonna have going all the way up. When I say position, I mean like trade. Like I'm gonna have one trade going all the way up here, and I'm gonna have another trade. I'm gonna take it at the same time when I take this one, and the stop loss is gonna be the same, about like 30 pips. Except for this trade, I'm only gonna take it to right here. So let's say the reason why I'm trying to really tell everybody about like taking multiple positions is because look, let's say you're in a trade, and this what happened a lot. Like I can't even stress how many times this time. You'll be in a trade and price will go up 30 points. So now this position has made 30 points, and then you'll think it'll keep going up, and then it'll start turning around and going down. That doesn't necessarily mean loss. If you this is where I'm finna start getting like a little more intermediate. Usually when price is up, like when it's up a little bit, they always say move your stop loss to break even. Your stop loss to break even means your trade needs to do this, and this trade will need to do this. Now you have your stop loss is at your entry price. So if price does come around, let's say you're in this trade, both of these trades, they went up to about 2.79, which was for UJ. This one hit about $2.79, so you close it out. Now this trade you kept going because you figured it would go up, but it never went up. It never went up, and it actually came back and turned around. Now that it turned around, your stop loss, I can't move it, can't find it. Your stop loss isn't set down here like how it was at first. You move your stop loss in. 9 times out of 10, you probably moved in profit. So even if it comes back and hits your stop loss, you might not have made the $18 that you wanted, but you didn't lose the $3 that you seen the first two. You actually didn't lose at all. You ended up probably still in profit. You probably ended up with like 10 cents profit, 20 cents profit. That might not sound nothing to you, but anything sounds better than losing. You cannot go broke taking profits. So, yeah, please, please, please. I don't know who's gonna watch this video. Please, 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 please watch risk management. Study risk management hard. I've been trading for a long time, and it's crazy. Like I had like a lot of clean strategies. I had a lot of clean setups, but my trading never went through the roof until I got risk management understood. Because risk management goes hand in hand with your actual emotions and how you treat the trade. It have been times where I've been in a trade and I had too many positions open. Like my account was too low, and I had too many trades going. So assuming that if all of these trades hit stop loss, then my account would be blown. I would have just lost all the money that I had. So to stop me from losing money in my account that I thought I was gonna lose, I would be in the trade and I'd probably be down like -$3, -$4 when I have confidence that it can turn around and go up. But I ended up closing my trade in negative, like -$3, -$4, and then the trade turned around. But I couldn't catch the turnaround because I already closed my trade out because I didn't want to lose money. It's crazy. Like risk management is really, really crazy. It's a whole psychology game. Come in short, especially with this risk management thing, and you'll be good. So, I mean, that's all I wanted to run through. I know I said I wasn't gonna make this video long. I know I made this video long, but it's all good. You know, I always got to provide value. So that's it. Got more videos on the way. Peace. Peace. Peace.